Hello everyone, today I'm going to talk about the USA markets and global economy outlook, as well as my own investment going forward. Firstly, we will look at the USA equities. This chart I get it from JPMorgan and Chase. Link is in the description below. Back to the chart. For over the last 25 years, we have about 3 crashes that we can see. Firstly is the dot-com bubble crash back in 2000, where the market loses 49% of its value, followed by the 2007-2008 global economic crisis, where the market loses 57% of its value. After that, we have a long period of uptrend, where the market rises by 400% since the last crash, and a brief crash back in 2020, where the market loses 34% of its value. Since then, the market has been up by 78%. Over the last few months, we have been hearing a lot of doom and gloom about market crashes coming soon. There is some substantial basis to it. If we look at this chart, we can clearly see that the S&P 500 is within the range of the previous PE ratio high back in the dot-com bubble burst, which is 24 times. Currently, we are at about 22 times the PE ratio. For the 25-year PE ratio, it is about 16.6 times. So this is where we are a bit concerned on whether the market will crash to the average or whether it will continue upwards. But as I can tell, the upward movement will be much limited, or there's maybe a few stagnation due to the high PE ratio. But currently, the high PE ratio is mostly caused by the Federal Reserve printing out money. Now we will look at the stock market since the last 120 years. Before 1920s, we have a stagnation of stock market, followed by a roaring 20s, followed by one decade of depression, and then we have World War II. After World War II, we have a boom, followed by the Vietnam War, where there's a stagflation within this time frame, and then followed by a boom during the Reagan era. Then this boom is stopped by the dot-com bubble burst, as well as the global financial crisis. And then we are currently at another boom where we encountered a small bump, the COVID-19 bump, which may or may not be a crash, but from this big chart we can see that there is still more upward movement for the US stock market. I've been hearing a lot of hyperinflation coming soon because of how the Fed has been printing out endless amount of money to keep the economy afloat. Now this chart shows different scenarios of how rising or falling inflation will impact the economy. As we can see, for rising inflation, the emerging markets and gold has been a good hedge to the inflation, and for falling inflation, also the emerging equity as well as growth stocks. Throughout all these 4 scenarios, we can conclude that equities is the way to go if you want to park the money for some return. So as a conclusion on US equities, we can see that the S&P 500 is in an unprecedented uptrend because of how the Fed has been printing out trillions of dollars, and big names in the investment world such as Ray Dalio, Warren Buffett, and also Bill Gates have been sounding alarms on the consequences of the Fed continuously printing out money. So my take is that, as I am an active trader as well as a passive investor, I mostly use my gains from trading and channel it to buy ETF through dollar cost averaging. These are the money that I can afford to set aside for the next 10 years. Some of you may ask why I use a passive investing when I am an active trader. Now, my answer is that these are the money that I can put aside for the next 10 years or 20 years even. So let's say I give you a scenario where the starting amount is 10,000, then you contribute weekly 500 into your ETF. Let's say the rate of return is positively 7%. So if we give it 20 years to grow, we will have 1.1 million by the next 20 years. Next, we will look at the international markets. If we look at the pie chart here, we can see that the market capitalization of USA is 58%, which is the largest in the world, followed by emerging markets and the Europe, each with 13%. If we look at the annualized return for the last 15 years, China has been giving out 12% annually, followed by USA, which is 10% annually, followed by India, which is 8% annually. Just now we have been talking about how high the PE ratio of the S&P 500 is going on now. Now, how about the rest of the world? For emerging markets, we can see that it is about 15 times. There's still some room to go. For China, which is 15.6 times, which they have a huge room to go, but beware that for the past decades, their government has been using subsidies and currency manipulation to jack up the price of their stocks. For Europe, it is about 17 times. There's still a bit room to go. For Japan, it is fairly good to say that it is undervalued. So my conclusion on the international markets is that the USA is still the leader, but at the moment, institutional investors are looking into China and emerging markets such as India and Indonesia for better yields. My take on it is that we have to watch out for China-related investments because they are filled with frauds, fake accounts, lack of transparency, and by the end of the day, everything can be confiscated by the CCP government anytime. And then with new innovations on electric vehicle, cryptocurrency, space, digital money, biotech, the leader of this innovation would be the winner or the leader of the future. For me, I am still using passive investment style in the US equities. Some hedge fund managers has been recommending to have a 50-50 portfolio, which is 50% in stocks and 50% in bonds, to reduce the risk and volatility of the market. As we can see in 1 year, last year we have a drop of 39%, but if we use a 50-50 portfolio, we have only a drawdown of 15%. However, if we look at it over 20 years, the return of stocks is higher, which is 17%, which is 3% higher than the 50-50 portfolio. So for those who are looking to retiring or who are aged around 60, I recommend a 50-50 portfolio to reduce the risk exposure, or you can fully transfer your stocks investment or into bonds. The next chart shows the importance of having a combination of bonds and stocks in your portfolio to endure through any crashes that might happen. For example, the recent COVID crash, if you have 40% stocks and 60% bonds, you will encounter the least drawdown, about 15% only. However, when the market recovers, you only gain about 9%. For me, I would prefer S&P 500, but I will have to endure a drawdown of about 39%. However, when the market recovers, I would stand to win likely 19%. So now we arrived at our conclusion on investing principles. REITs has been shown to be a good asset class to hold because it is able to provide a substantial yield to the investor. A portfolio of stocks also provide the highest volatility, but it proves to be the best in return on equity over a span of 20 years. For me, I'm currently channeling my income from employment and active trading to ETFs. My current ETFs include the Asian ETFs, which is for the emerging market, and S&P 500 index fund. I'm also doing research on REITs ETF so that I can further diversify. Furthermore, REITs for me I think is a good passive income because it provides good dividend and also capital appreciation over the years. Well, that's it for this week. Hope to see you again in the next video. Bye bye.